Most investors don't even survive 365 days in the stock market. They quit when things get tough. But what if you had stayed not for 365 days, but for 3655 days? That's a full tenure in a mutual fund. Could you survive through market crashes, global crises, pandemics, wars, scams, and still come out alive or even rich? Today, I'm going to show you what happens if you do. And here is how this video will flow. We'll have 4 sections. Section 1 is the challenge, which is can you stay invested for 3650 days. Second, I will take you through the obstacles that you will face. Third, I will reveal the payoff. And finally, the lesson twist. The biggest reward in investing is not about winning, but simply about not quitting. And I will prove this with some data. So here is the problem, that is the obstacle. Surviving 365 days in a mutual fund is not easy because during these times the market throws everything at you. The 2008 global financial crisis wiped out 50% of portfolios. Euro debt crisis made people believe the whole system would collapse. Demonetisation shook India overnight. Then came COVID. Markets were locked down. There was panic everywhere. And just when you thought it was over, then there was inflation, war, scams, rate hikes, and tariffs. Every one of these headlines made investors quit. But if you did not quit, if you survived each storm, your reward was waiting on the other side. This is what 10 lakhs of yours would have become if you just survived 3650 days in a mutual fund. You don't need to be the smartest investor. You don't need to time the market. You just need to outlast everyone else for 3650 days. So how do you actually survive 3650 days inside a mutual fund? Think of it like a survival game with a few golden rules. 1. Don't stare at the market every day. Checking your portfolio daily is like checking your heart rate every 10 seconds. You will panic. Look less, survive more. Second, automate your investments through SIPs smartly. The best investors, the best survivors don't fight the market. They set up automatic investments and let compounding do the heavy lifting. But listen, I won't suggest that you blindly SIP into a fund that is already at crazy valuation. For example, if small caps are overheated, delivering all-time high returns, I would not even touch them with a regular SIP. Instead, survivors choose flexible categories, hybrid funds, multi-asset strategies that can balance the risk and rewards. Bottom line, align your fund selection with your goals and risk tolerance, not with returns. Valuations at the time of entry matters the most. Third, rebalance. Don't react when markets crash. Most people panic and quit. Survivors don't. They rebalance. That means you sell a little of what is expensive. You buy a little of what is cheap. You only do this at extremes, not at every dip. And remember, rebalancing is not exiting. It is selling to buy more. So your survival journey continues better. Fourth, focus on the 365-day reward, not the headlines that screams scary news every day, like crisis, wars, scams, inflation. Survivors know this, that these are the obstacles, they are not the finishing line. Rule 4, trust the 3650-day reward, not 365-day noise. Every single year the market will test with scary headlines, recessions, wars, scams. In last week's video, I showed how markets crash 20% almost every year. And when you see that data, you will mentally prepare. These crashes and noises are just survival obstacles, not the finish line. If you zoom out, those moments will look tiny bumps on a compounding curve. Survivors don't get distracted by these noises. They keep their eyes fixed on the 3650th day reward. Now let us fast forward. You just invested, say, a sum of money in 25. The journey has just begun. Year 1, markets are at all-time high. Everyone is making money, feeling good. But wait for 6 months. A global scare will send the index crashing by 20%. Your friends will panic and sell, you will hold. Year 3, a banking scam breaks out. The headlines will scream, markets will collapse and mutual funds are over. But a year later, maybe 2 years later, markets will bounce back as if nothing has happened. Year 5, a pandemic can shut down the world. Your SIP still quietly get deducted from the bank even when you're scared about the job. You hate it, you wonder whether you're doing the right thing. Year 7, a war breaks out, another corner of the globe, oil price shoots, inflation bites the market, markets fall. This is when most people will quit. Year 10, you look back, you have survived the scams, wars, pandemics, elections, inflation, interest rate cycles, literally a decade of chaos. But your money did not just survive, it continued to grow. If you expect 12% as the return that your funds can generate, then 10 lakhs invested on day 1 or a similar amount thereabouts will double in about 6 years. Using the rule of 72, you can estimate how long it takes for your money to double. The rule of 72 states 72 by the rate of return will give you the number of years it takes to double your money. So if you expect 12% return, then 72 by 12 is 6. So you expect your money to double every 6 years at 12% rate of return. Then it will be 4 times in 12 years. That is a little more than 3650 days. So 10 lakhs invested in day 1 for a sample illustration will be 40 lakhs after 2 doubling periods in 12 years. This is purely illustrative in nature just to help you understand the power of compounding. Mutual funds have no guaranteed returns, so please consult your financial advisor before investing. I used to have a manager at office long back who had a very curious habit. Every evening before leaving, he would cross off the day in the calendar. At that time, I had no idea why he did it. But today I realize there is a practical lesson for me, a way to survive 3,650 days in the market. Here is how it works. Get a 10-year weekly calendar where each week is represented by one square. Every Sunday, you cross off one square. That gives you roughly 52 squares per year. And over a 10-year period, you have 520 squares to conquer. Each square represents a challenge. Sharks, serpents, and other creatures trying to scare you, make you quit. In reality, these are the headlines, market noises, and panic. These are inducing events that will constantly tempt you as an investor to sell. Your goal is not to fight each wave, it is to cross those squares consistently, week after week. Starting today, your calendar will look something like this. An insight supported by a research from Value Metrics. Most investors believe they can predict the market, they can time their buys and sells perfectly based on the latest news. But even the most seasoned professionals, they struggle to do this consistently. Look at the scatter plot of the best and the worst days in the markets. You will notice a pattern here. The best and the worst days are often clustered together, and trying to time them precisely is impossible. That is why survival is the real edge, not timing. For example, take the year 92. The best days to invest was in February. But interestingly, the worst days were also clustered right around the same time. Again, look at another time, 20. The best days were immediately after the worst days. And that is true across. What does this mean? If you exit the market for even 1 week because of bad news, you not only avoid the losses, but you also miss the best days. The sharp falls are often followed by sharp rebounds, and trying to safeguard against declines can cost you the recovery. Missing the best days dramatically impacts your returns, as you can see in this chart. So here is the reality from this research. If you remained invested throughout the entire period, you earned 14% annualized return. Miss just 1 week and your return drops to 11.6%. Miss 2 weeks and it falls to 9.9%. Miss 4 weeks and your return plummets to a shocking 4.5%. That is why the challenge of staying invested for 520 weeks makes so much of a difference to your portfolio. You literally cannot afford to miss a single week. So are you ready to take this challenge? Share your thoughts in the comment section. I would love to hear your views, your plans on how you want to stay invested, and I would be very interested to engage with you. Thank you for watching. If you like the content, please hit the like button. Consider subscribing to this channel and share it with your friends.